Now, how do we go about estimating the parameters of the CAPM? Primarily, of course, the individual risk asset betas, but also perhaps we should think about the expected return to the market portfolio. But thinking about the beta, well, we know how to estimate it from the security characteristic line. We know that we should take excess returns, regress them on market excess returns. That will give us an estimate of beta. And we saw in the single index model how to go about doing that. So that part actually ports directly to the CAPM. But another way to do it is actually to simply use the statistical definition of the regression beta, which is the covariance between your y variable, the individual risk asset return, and your x variable, the market return, where, remember, the beta is essentially the covariance of the two over the variance of the x variable, the market return. So how can we do that? Well, let's go back to our Chapter 5 sort of simplification of complex distributions, because the market return of course follows a continuous distribution, so does your individual asset return. And that's a little bit hard to think about, but let's simplify it with payoff trees as we've previously learned. So let's say that we have two equally probable states of the world, and we have one particular risk asset that we have in mind, and also the market. And we know that the returns of the two assets are what they actually are. The market, in the, let's say, good state of the world, which has a 50% chance of coming about, the market gains 20%. In the bad state of the world, which then must also have 50% chance of coming about for them to add up to 100% cumulatively, that has a negative 10% return to the market. So if we want to compute the beta of our risk asset, well, that means that we need the covariance of the risk asset with the market, and we need the variance of the market. Remember, the input to both of these is essentially going to be the deviation from the mean. So for the market, let's calculate, first of all, the mean return to the market. Well, half of the time it earns 20%, half of the time it loses 10%. Therefore, on average, it earns 5%. In the good state of the world, the deviation from the mean is 15%. In the bad state of the world, the deviation from the mean is also 15%. So the square deviation, because remember, both variance, well, specifically actually variance, will operate on square deviations, whereas covariance will operate on products of asset, of the individual asset deviations multiplied together. The square deviation for the market is 225 in both cases. And if we probability weight that to construct that expected value of the square deviation from the mean, which is to say the variance of the market is 225. The standard deviation of the market is the square root of that, or 15%. Now, that's the market. What is our individual risk asset like? Well, let's say this risk asset in the good state of the world that comes about with 50% likelihood, that risk asset earns 6%. In a bad state of the world, this risk asset earns actually more, 10%. So it seems like this asset actually gains more in the bad state of the world. So we may then think sort of intuitively what the relation between this risk asset and the market must be. This looks like the beta is actually going to be negative, right? Because the market actually gains more in the good state of the world. This risk asset gains more in the bad state of the world. But let's actually calculate that out and see what the beta would be. Well, what's the expected return on this risk asset? It's 8%, because half of the time it gains you 6%, half of the time it gains you 10%. This, by the way, is some risk asset, because it's not terribly risky, is it? Because it never actually seems to lose very much. But the expected return is 8%. The deviation from the mean is therefore -2 in the good state of the world, +2 in the bad state of the world, and the square deviations are 4 in both states of the world. Therefore, the variance as the expected value of the square distances from the mean is going to be 4. And therefore, the standard deviation of payoffs of this risk asset is going to be the square root of that, or 2%. So now that we actually have the two variances, we know the variance of the market is 225, the standard deviation is 15%, the standard deviation of the risk asset is 2%. What's the covariance between the two? Well, remember, that's sort of the expected value of the product of the asset-specific deviations from the mean. So for the good state of the world, the market's deviation from the mean is 15. The risk asset's deviation from the mean is -2, as we calculated here. And in the bad state of the world, the market's deviation is -15, and the risk asset's deviation is 2, as we calculated here. So, unsurprisingly, these two assets have a negative covariance because, again, the market moves up and has a positive deviation in the good state of the world. The risk asset moves up in both, but has a positive deviation from the mean in the bad state of the world, where it gains a above mean return of 10%, where the mean on this asset is 8%. So now if we have the covariance between the two assets of -30, we can actually then calculate the beta of this risk asset, which is, remember, the covariance over the variance of the market asset. So let's take our covariance substituted in the numerator, take our variance of the market portfolio substituted in the denominator, and we see that the beta of this asset is -0.133. First of all, it's not terribly high, mostly because this asset actually doesn't deviate from its mean return too much. And second of all, it's negative, because of course we know that this asset actually moves inversely to the market. It gains more in the bad state of the world, whereas the market gains more in the good state of the world. Now, the beta, of course, being the covariance divided by variance, is related to the correlation, right? The correlation is the covariance divided by the standard deviation of the market times the standard deviation of the risk asset. And it shouldn't surprise us that the correlation is actually -1, precisely because the risk asset gains more when the market asset loses all the time. Now, how do we interpret a small negative beta? Well, first of all, just the fact that we have a negative beta means that when the market changes by X%, well, the security that we have in mind here changes by -0.133 times X%. So in other words, if the market has gone up by 10%, the security would be expected to fall by -1.33%. In other words, this asset will actually move in the opposite direction from the market, and the fact that it has a correlation of -1, that means that whenever the market earns an above average return, this asset earns a below average return, and vice versa. Now, another important thing that the CAPM lets us do is actually similar to the single index model. Remember, the CAPM is sort of a special case of the single index model, just more rigorously proven, is it lets us create a variance decomposition. So we can actually say that a certain part of a risk asset's total risk as measured by variance, is going to be the systematic component coming from its exposure to the market portfolio, and a certain part, well, whatever remains, is going to be the firm-specific part. Remember, there's not really going to be a covariance between these two, mostly by definition. Anything that's firm-specific has zero covariance to the systematic sort of macro level of risk. So if we can estimate a beta for an asset, now we can actually say what portion of the asset's variance, because we can estimate the asset's variance as well, is actually going to be due to the exposure to market risk, and what then the rest must be, which is then of course just due to firm-specific risk. So how do we actually go about doing this? Let's go through an example. Let's say we have a firm in mind, and this firm is Apple, and we use regression to estimate its beta. We get an estimate of 1.3, and we have looked at its historical returns, and we see that they are, well, the variance of those returns is 0.36. Remember, variance is essentially in percent squared, as it were. The market portfolio has a variance of 0.04. So what then is the systematic and firm-specific variance of Apple? Well, let's actually calculate the systematic variance first. Remember, that first component of total variance is your systematic variance being beta square times the variance of the market. Well, your beta square is 1.3 to the second. Your variance of the market portfolio is 0.04. And therefore, the systematic variance of Apple is 0.0676. Well, therefore, since the firm-specific variance is going to be uncorrelated to this, and since firm-specific variance must, by definition, be what is left over once we've accounted for systematic variance, then we can just say that, well, if our total variance is 0.36 and our systematic variance is 0.06, then the firm-specific variance, actually being a substantially large portion of the total risk of this firm, of Apple, is 0.2924. In other words, just sort of what is left over from total variance once we have subtracted systematic variance. And of course, since the market variance is going to be the market variance for all stocks, that will never change if you look at, instead of Apple, looking at Microsoft, the market's still going to be the market. And that means that the systematic variance of any stock is essentially just going to be directly proportional to the beta of that stock, and that's again very consistent with what we know about risk from our discussion of the single index model. Now, another interesting property from regression is that this ratio of total risk, as represented by the variance of the returns of the individual asset, and systematic risk, or market risk, as represented by beta square times the variance of the market, is actually captured by that R square statistic that we saw from regression output in the single index model discussion. So the R square actually captures the ratio of those two, the ratio of systematic variance to total variance. So if we have access to a regression model, we don't even necessarily need to manually multiply, beta square by market variance. We can just look at the R square statistic, and that will tell us what proportion of the total variance of the individual asset is actually systematic variance, and therefore what the remainder is as firm-specific variance. So if we ran a regression model on the market portfolio and we got an R square for a particular risk asset of 0.16, Well, it means that systematic variance or market risk is essentially 16% of the total risk of this asset, and the remainder, a whopping 84%, must then be firm-specific. In other words, this asset is sort of highly idiosyncratic. It does its own thing, largely independent of what the market does. But remember, what is the sort of priced component of risk that this asset takes? That's just the market risk. So really, this asset, only 16% of its total risk is priced. Therefore, one useful diagnostic of R-squared, assuming we have the right asset pricing model in mind, if the CAPM holds, then for this particular asset, we would probably want to hold it in a highly diversified portfolio to get rid of that vast majority of its total risk, the 84%, that is actually not priced, that is idiosyncratic, specific just to that particular firm.